topic for today. Fixed exchange rates, how they work, and some discussion about the pros and cons of fixed versus floating exchange rates, and a little bit about China. You probably all heard that China is somewhat frequently referred to as a currency manipulator, and we're going to talk a little bit about what that might mean and whether it applies or not in the case of China. So those are the topics for discussion. This is also the last class we're going to have on international finance. So last time we're going to talk about exchange rates and balance of payments and trade deficits and stuff like that. All right, what's up in front of you is a bunch of mess from last week at the end of class, and I'm going to start by walking us through the exercise that we did at the end of class last week. The discussion at hand was what happens or how does a country maintain a fixed exchange rate with respect to another. Now, we've got to put it in terms of some context, and the context we're using here is listed up here at the top, that we're going to imagine that the U.S. is fixing the U.S. dollar to the British pound. Now, that's never really happened in history, but it doesn't matter in order to get the gist of the principle across of how a country would do this. And then we'll flip it around and talk about, for example, China fixing to the United States or other countries fixing to other countries' currencies. So let's just do it in this context just to get the idea of how it works. So we're going to imagine that the U.S. fixes its currency at some fixed rate, say E bar, and we start out with an initial equilibrium where supply and demand are equal to each other, which was listed as here, let's call it point A on the diagram. Now, everything is fine if supply and demand is equal to each other and everybody's happy. But what we do to illustrate the dynamics of the market is actually introduce some kind of a change in the private market and then show how the central bank intervenes in order to try to maintain the fixity of the exchange rate, to make sure that that exchange rate is credible. So what we do is start out with the assumption that interest rate parity prevails, and in the fixed exchange rate case, that rate of returns being equal to each other simplifies to a much simpler formula, namely that the interest rates are indeed equal to each other. So that's what has to be maintained or would be maintained in a fixed exchange rate system. Now, we introduce a stimulus to the economy, and the stimulus was a decrease in British interest rates. Average interest rates fall in Britain, and what could be one of the reasons that could cause interest rates to fall in Britain? What might motivate that or cause it to happen? Any ideas? What's the most likely cause of a decrease in interest rates in a country? Central bank intervention. Increases in the money supply by a central bank would tend to cause interest rates in that country to fall. Increasing money supply, decreasing interest rates. So in the background, let's keep in mind that maybe this got set off by an increase in money supply by the British central bank. Okay, so interest rates fall, and we ask, well, how would that affect the foreign exchange market? And here we imagine lots of investors are participating in the market and trading currencies to move their assets back and forth between the two countries on a particular day. Now, what we said would happen is because the drop in the British interest rates, initially that's going to make the U.S. dollar interest rates greater than the British pound interest rates. That's going to make U.S. assets or deposits more attractive for the moment. That will inspire investors on the next day to increase their demand for dollars. They'll want to buy more dollars to take advantage of the slightly higher interest rates that now prevail in the U.S. economy. Now, that, in terms of the diagram on the left, is going to mean an increase in supply of pounds, because if you're increasing your dollars demand, you're going to be exchanging pounds in exchange for those dollars, so there'll be an increase in the supply of pounds to make that possible. So on the diagram up here, we get a shift to the right of the supply curve for pounds, and that would put pressure on the exchange rate to fall. Exchange rate being pushed down means that the pound is being pushed down in value and the dollar is being pushed up in value. At least there's pressure for that to happen. Now, the central bank doesn't want to allow that to happen because it wants to maintain a fixed exchange rate. So here's what it's going to do. It's going to intervene in the market by doing the reverse of what's being demanded by the private players. Private players are increasing their supply of pounds, so the central bank is going to step in and increase their demand for pounds. And the increase in demand for pounds is going to result in an increase in the buying of pounds by the central bank. And to make an exchange, to make this possible, they're going to exchange it for dollars. So they're going to be available in the market to buy or sell currency upon demand. And when there's an excess, as there is here, an excess supply of pounds, the central bank in the U.S., because the U.S. is fixing the currency, is going to purchase up those excess pounds that are available and sell U.S. dollars. Or, in other words, to think about this is they're supplying the excess demand for dollars by investors who are trying to seek to invest in the U.S. market. Okay, so increase in the sale of dollars, purchase of pounds, is going to increase the money supply in the United States and lead to a decrease in the interest rate eventually. But the most important effect of this is going to be that it will shift the demand curve for pounds outward to the right. This buying of pounds is an increase in demand, and that enables the central bank to keep the exchange rate fixed at E bar. Okay, so that's the mechanism that a central bank is going to use. And what the central bank does is basically stand ready to buy and sell currencies as needed in order to equalize supply and demand for the currencies on a particular day. So in this case, we told a story where there's an increased demand for dollars in the market. The U.S. central bank steps in and says, oh, there's too much demand for dollars? We've got dollars. We will supply them to the market and buy up the pounds that are being supplied on the other side. All right, so we'll buy pounds and sell dollars, keeping the exchange rate fixed. And this is how the central bank will intervene. Now, there's some terminology I need to introduce. In this particular case, the central bank is buying up the foreign currency, the pound. Pound is what the country is fixing to. The US dollar is being fixed to the British pound. But we call this kind of transaction by the central bank, we've got a name for it. And we call it a balance of payments, or BOP for short, surplus. A BOP surplus occurs whenever the central bank buys foreign reserves, or foreign currencies, they should say. Whenever the central bank buys foreign currency, we call it a balance of payments surplus. Don't worry about the terminology too much, just learn what it applies to, or learn what transaction is represented or called a balance of payments surplus. Now, when it buys foreign currency, it's buying up pounds, and then it can't sell them immediately to somebody else because that would be supplying the pounds on the market and it would mess up the exchange rates. So what it does is it holds on to those pounds that it purchases up. It holds them, we say, as a reserve or in reserve. And that's why we call this a reserve currency. The central bank that's fixing its exchange rate has to hold on to a stock of currency that's issued by the foreign bank, foreign central bank. Now, the way in which the central bank is going to hold on to these British pounds in this scenario is that it's not actually going to hold on to pounds in a vault somewhere in the United States. Instead, it's going to take the pounds, maybe billions of pounds that it just purchased up, and it's going to invest them in the British market for the moment. And the way it normally invests it is to buy treasury bills issued by the British government. So the way in which the central bank in the U.S. would hold on to its reserves is by holding treasury bills or bonds issued by the central bank. And in that way, they earn some interest while they're holding these so-called reserves. Okay, but it is important to recognize that a country that's holding on to foreign reserves is not holding on to them in their own country, tucked away from the country in question. The money that they're holding as reserves are back in the country, circulating around and being used. They're holding on to an IOU, a piece of paper that says, Treasury promises to pay you back so much money with interest at some point in the future. So the reserves they're holding is just a piece of paper. The money itself is actually back in the country in question, circulating around and being used. All right, now that's important because when we look around at countries who have high reserves, China is one of them, and they're the country that has the highest level of foreign reserves of any country in the world, and currently it amounts to about $3 trillion worth of reserves. So it's important to know that does not mean they have taken $3 trillion out of our economy and have tucked it away in a bank in a place that we can't get to. Instead, they're holding on to $3 trillion in treasury bills issued mostly by the U.S. but by other country governments as well. And that money is still circulating in the U.S. economy. We just have to, some IOUs we have to pay them back in the future. Okay, now we're going to do another story It's really the same story, but just in the opposite direction. So let's start with the same scenario of US dollar being fixed to the British pound. Quantity of pounds on this axis, the exchange rate dollars per pound on this axis. Supply and demand curve for pounds. Supply of pounds upward sloping, demand for pounds downward sloping. Fixed exchange rate at E bar at the intersection of supply and demand for the moment to make our analysis nice and easy. And now we're going to imagine the following scenario. Let's suppose what sets off some changes in the market is that the U.S. increases its money supply. Money supply in the U.S. is pushed up through an open market operation or some other such measure. That increase in money supply, and we're not going to talk about the mechanism here, is going to tend to cause a decrease in U.S. interest rates now. So instead of British interest rates going down, we're going to imagine that there's a decrease in U.S. interest rates. And that's really what's going to motivate the changes that take place in the marketplace. Now, the decrease in U.S. interest rates, since interest rate parity held before, this is now going to inspire the following. British interest rates, on average, are going to be greater than U.S. interest rates because we're imagining that at the initial equilibrium, interest rate parity prevailed. What would this do to supply and demand for pounds in the foreign exchange market? So if British interest rates are higher than U.S. interest rates, what happens to supply or demand for pounds in the market?
Increases demand.
Demand goes up. Demand for pounds is going to go up. So investors, on average, are going to demand more pounds to take advantage of the higher interest rates that prevail in the British economy. All right, so this is going to inspire increase in the demand for pounds. It may also decrease the supply of pounds, but I don't want to introduce all of the different changes that might take place. Just let's do one. It'll be enough for us to consider the effects. An increase in the demand for pounds means that the decrease in U.S. interest rates is going to cause this demand curve for pounds to shift outward to something like D prime pound. And it's going to put pressure. This is going to put pressure for the U.S. dollar to depreciate or the pound to appreciate. So I'll put it this way. Increased pressure for the pound to appreciate. Now, if there's an increased demand for pounds in the marketplace and the central bank doesn't want to allow the exchange rate to go up, the pound to appreciate, then the U.S. central bank, who is the entity trying to fix the currency, is going to have to intervene to prevent this from happening. So how would the U.S. central bank intervene in this particular case to offset the pressure being caused by the increased demand for pounds? What do they do?
Decrease the money supply? Decrease the money supply?
Decrease the money? Not the money supply change. Let's go more directly to influencing the foreign exchange market. So there's an increase in demand for pounds. What does an excess demand for pounds, we could say? What does the central bank do in the foreign exchange market?
Sells the British pound.
Sells the pounds. If there's demand, they're ready there with extra pounds to sell to the people who are demanding them. So the excess demand is satisfied by the central bank selling pounds. And if they sell pounds, what are they doing on the other side? What are they buying? If it's the foreign exchange market, they're buying their own currency, so they're buying dollars. Now, that purchase of dollars has an effect upon the money supply. So the exchange takes place first, and then that's going to have an impact or an effect upon the money supply in the United States. But first, I want to highlight that this particular transaction means that they're selling reserves, selling the foreign currency that they're holding on in reserves in this particular circumstance. And so we're going to call this kind of transaction a balance of payments deficit. So whenever a country sells off its foreign reserves, it's running a balance of payments deficit. Anytime it buys up its foreign reserves, it's running a balance of payments surplus. Keep that in mind. Question?
So you said the United States buys up these reserves and holds them in like treasuries for the other country. So when it does this, when it intervenes, aren't these treasuries on like a time frame?
Oh, like there's a term to them. There's a maturity. Yeah, there are, but you don't have to wait and hold them to maturities because there is a so-called open market for bonds. And an open market means you could take a 5-year treasury that's due to that's maturity is 5 years from now. There's a market today that you can go to and you can sell that to somebody else. So I could hold it for 5 years, or I could take that bond to the open market and I can find some other bank or institution that might be willing to purchase that from me on that particular day. Every day there's a market for 5-year treasuries, 10-year treasuries, terminations in 7 years and 8 years. You can buy and sell those on a daily basis. And so there's always a place you can go to in a well-functioning capital market like the US and Britain. And you can make exchanges like that.
You're not breaking the contract between that country?
No, because all that's happening is you're transferring the piece of paper that says the government will pay you back in 5 years, and you're giving it to somebody else. Now the government's going to pay them back in 5 years. So whoever's holding that certificate at the end is the one that gets the payout from the government. Which means that if you wait a little bit longer to sell it, you're going to have to sell it at a kind of a higher price, because it's going to pay off to that other person sometime soon, with the payoff. And that's how those bonds work. Yeah.
Sorry, so the central bank sells its currency, that's when it's running a surplus?
Wait, the country sells its reserves.
Reserves.
So the reserves is the foreign currency. So if they sell off their foreign reserves, then they're running a balance of payments deficit. If they sell their own currency, don't think about it that way. It's better to think about it the other way. Selling foreign reserves, balance of payments deficit. Buying foreign reserves, balance of payments surplus. And think about that deficit or surplus in terms of whether you're adding or subtracting from your reserve holdings. That's the best way to keep track of it. All right, now this transaction is going to have the effect I mentioned before of buying dollars, so you're going to decrease the U.S. money supply, which is unfortunate because the whole reason this problem arose in the first place was because of an increase in the money supply in the first step. So increase the money supply, and you can do that domestically. You don't have to intervene in the foreign exchange market to try to affect the size of your money stock within a country. You can buy or sell domestic bonds to try to affect the money supply domestically, which is what we started off this exercise with. The effect is, though, to lower the money supply once the central bank is forced to intervene because of the change in the exchange rate caused by investor behavior. That money supply falling down causes the U.S. interest rates to go back up. And it's going to continue to go up until I dollar equals I pound again, until interest rate parity prevails. So now here, what's kind of interesting to note is that the U.S. tried to affect its money supply and change its interest rate. But because it was also maintaining a fixed exchange rate, it was forced to intervene, and that intervention caused its interest rate to come back to equality with the pound interest rate in Britain. In other words, the transaction or the transition that took place is that the U.S. interest rate went down at first. That was this step. And then it was forced through the foreign exchange intervention to come right back up to where it started. In other words, it couldn't be affected at all by internal money supply changes. Now, this is a very important point, because what it suggested is, and what it shows us, is that a country that fixes its exchange rate to another does not have any direct control over its own money supply and cannot affect its interest rates in any meaningful way, because you're tied to the interest rates of the country to whom you're fixing. Okay, so in this particular case, the U.S., by fixing its currency, its exchange rate to the British pound, is in essence adopting the British interest rate. And if it tries to change its own interest rate, as it tried to do in this exercise, its intervention on the foreign exchange market is going to force it to move its money supply back to where it was, to bring its interest rate back to where it was, and to have no effect upon its economy whatsoever. So the fixed exchange rate renders monetary policy ineffective. Monetary. How do I write it? By fixing your currency, you lose control of your money supply and your interest rate policy domestically. And you are fixing yourself to the money supply in essence and the interest rate policy of the country to whom you are fixing. That means you lose what's sometimes called monetary policy or monetary autonomy, independence. You lose the independence of your own monetary policy. And that's one of the features of maintaining a fixed exchange rate with respect to another country. Now, we're going to talk in a minute about whether that's good or bad. The first question.
That was my question.
That was your question. Okay, we're going to get to that. Is it good or bad to lose your monetary autonomy? Well, the answer to the question really is it depends. It depends on the circumstances in which you're facing. And we're going to get back in a minute to some of the reasons why countries choose to fix their currencies to other countries. Okay, but before I do that, I want to highlight another important point about this process, and especially this set of steps we've made here. Because suppose that the process in question here is not a one-time shot, one-time deal that this is happening. Let's say it's happening over and over and over and over again. For some reason, the U.S. keeps increasing its money supply time and time and time again, causing the pressure for the currency to appreciate, for the pound to appreciate, dollar to depreciate, but the central bank has to keep intervening on the other side to bring it back down. If you're forced, in other words, to run balance of payments deficits over and over and over again, there's a problem. What's the problem you're going to run into? Any idea? Yeah? You will run out of reserves because this process means you're selling off your foreign reserves. You're selling off the pounds, and in order to make this possible in the first place, you had better start your fixed exchange rate system with a stockpiling of pounds in your possession so that in the event you need to buy or sell, in particular sell pounds, you have them available to do that. So you've got pounds to sell in the event that there's pressure for your currency to depreciate, and you can sell them off as necessary in order to keep your currency fixed and stable. This is one of the reasons why deficits on the balance of payments, though not necessarily best deficits on the balance of trade, but deficits on the balance of payments is a very bad situation because you could reach a point where you will not be able to maintain your fixed exchange rate any longer. You could run out of reserves. When you're about to run out of reserves, we call it a balance of payments crisis. Now, what happens if you run into that situation? Well, there's one possible outcome, a couple of possible outcomes, but the one most worrisome, perhaps, is that you may be forced into a devaluation. In this particular instance, there is pressure for the dollar to depreciate and the pound to appreciate. But you're trying to prevent the dollar from depreciating. So you keep intervening, running balance of payments deficits, selling off your reserves. You keep doing that over and over and over again until your reserves run out. Eventually, you can't take the pressure off, and you're going to have to change your currency value. When you change it in a fixed exchange rate system, it's called a devaluation. Changing that fixed rate to another rate. And since, as we can see, there's pressure for the currency, this exchange rate, to rise, a devaluation for the dollar is going to mean an increase in the fixed exchange rate to some higher level. The alternative movement would be a revaluation of the currency, moving it downward in value. But as we can see, perhaps by going back a step, that is not a problem you're necessarily going to run into. This is the step we started with today, and which we finished with in class last time. This process was set out by a decrease in the pound interest rate, remember? And it led to the central bank running a balance of payments surplus. In order to keep its currency fixed, in other words, it had to buy up more foreign reserves. Okay, but what's the pressure causing the purchase of foreign reserves? Is there an increased desire for your currency or increased desire for the other country's currency? In this case, the US. Is there an increased desire for your currency or the other country's currency? Your currency. Because the British pound interest rate went down, there's an increased desire for US assets. That's increasing the demand for US assets, and the central bank intervenes by running a balance of payment surplus to keep the exchange rate fixed. So increased demand for your assets is going to cause your currency to appreciate if it were floated. But you're preventing an appreciation from taking place, keeping your currency lower than it would otherwise be in a floating exchange rate market by building up your balance of payments, building up your foreign reserves and running balance of payment surpluses over and over and over again. Now we might ask, how long could you run a balance of payment surplus? Will you run out of anything if you run a surplus for too long? Think about that for a minute. Will you run out of anything? How do you buy up the foreign British pounds? Selling dollars. Where do you get the dollars from? Huh? Print them yourself. You're just creating them out of thin air. There is no limit to the number of dollars that the central bank can print, unless they're limited by law in some way that they can't do that. But in many instances, they're not. They're independent and they can do as they feel necessary to maintain what's some sanity in their economy, let's say. And maybe they believe it's very important to keep the exchange rate fixed. So even though there's pressure for their currency to appreciate, they're keeping it lower than it otherwise would be, and they're buying up foreign reserves in order to maintain that. Now, think about China when we tell that particular story. China is a country who has been accumulating foreign exchange reserves and has been maintaining a fixed exchange rate with respect to primarily the US dollar since about the early 1990s. During the 2000s, especially from about 2000 to about 2012, 13, 14 or so, China has been accumulating foreign reserves. They've been increasing. That means what about the desire for Chinese currency or Chinese assets? Has there been an increased demand for those assets or desire for foreign assets instead during those periods when they're buying up reserves? No, there's been increased demand for their own assets. So they're selling their currency, which is in high demand, and they're buying up the foreign reserves, the dollars in this particular case. So they're buying up dollars and they're selling their own currency, building up their foreign reserves. Now, had they not intervened in that particular way to maintain a fixed exchange rate, their currency would have depreciated considerably during that period of time. But they prevented it from depreciating by running sizable balance of payment surpluses and running up a reserve pool of almost $4 trillion as of a few years ago. All right, now, stop for a moment and we can ask, does that mean China is manipulating their currency? Well, it depends on how you determine or define that in some ways. First of all, manipulation means you're intervening in some way to affect your exchange rate. And China is certainly doing that. On the other hand, every country in the world that fixes its exchange rate to any other is thereby manipulating their currency because they're trying to maintain a fixed exchange rate. Now, let's go back a second and talk about some of the motivations for having a fixed exchange rate in the first place. All right, and then this will get at some of the issues between fixed and floating exchange rate systems. Okay, first of all, one of the main reasons for maintaining a fixed exchange rate is to eliminate uncertainty. And we've seen and had a pretty clear depiction of how uncertainty can affect participants in markets. Uncertainty like the following. If you don't know what the exchange rate is going to be next year or the year after, we saw in the last few weeks that can greatly affect the rate of return on foreign investments, right? And if the foreign currency that you're holding and the assets you're holding abroad go up in value during the year, no big problem, because you're going to make more money on that. But if the foreign assets that you're holding, if that country's currency depreciates considerably during the time you're holding those foreign assets, well, that's going to reduce your rate of return, and you could well lose a fair amount of money by virtue of that investment. Now, investors care a lot about what the exchange rate is because it greatly influences the rates of return on investment domestically and internationally. If you believe that motivating more foreign investment would be a good thing, would help some economies to grow more rapidly, would open up more funds available for investment opportunities, if that's a good thing, then you would like to encourage more foreign investment rather than not. But if exchange rates are jumping all over the place because you're on a floating exchange rate system, that generates a lot of uncertainties for investors. And maybe enough investors will just say, look, I don't want to deal with the exchange rate changes. I don't know whether this investment is going to pay off or not. I'm just going to keep my money at home instead. Then you might not get the optimal level or the ideal level of foreign investment that might take place. So, one of the motivations for maintaining a fixed exchange rate is to eliminate all of that exchange rate uncertainty that affects international investments. Yeah.
Don't a lot of honestly that pretty much the highest countries with the highest levels of investment, don't they all have floating exchange rates?
They do. Interesting.
So
Yeah.
they seem to hold up so much as we have
Now, one of the reasons for that may be because people are very clever. Investment bankers are very clever, and they think, hey, is there any way in which we can protect ourselves against the risks of depreciating currencies? Is there a way to hedge against the losses that we might incur abroad? And the answer is yes. There are many sophisticated investment strategies that can be used to try to ward off those volatilities in exchange rates and allow you to invest. It requires some more investment. It requires more expenses. You've got to hire more people and have them engaged in a more methodical way in terms of trying to make sure that your investments are tracking properly and that you ward off the changes that might take place because of floating exchange rates. So it's possible, and in fact, richer countries have a better chance of integrating and using these sophisticated investment strategies. So that means that floating exchange rates doesn't automatically mean that there's too much uncertainty. It just means you've got to take a few extra steps in order to ward off those uncertainties or to protect against them. Hedging strategies become very important in a system with floating exchange rates. So maybe that's too simple of an explanation. And in fact, one of the problems with this whole idea of reducing volatility with fixed exchange rates is that when we look back at the history of fixed exchange rates and ask, are they really fixed for a very long period of time? The answer is that for most countries who maintain fixed exchange rates in the past, they don't keep them fixed for very long because they devalue their currencies or they revalue their currencies from time to time, periodically, meaning that you still have uncertainty because you don't know when those devaluations or revaluations are going to come about. So this is an argument that could be used to support fixed exchange rates, but it's not a perfect argument. And there's reasons why, despite that, you might still be all right in the system of floating exchange rates. All right, well, let's tell another story. A second story for why you might want to maintain fixed exchange rates, and I think this is actually a more plausible one, is actually to go back to the second story we told here. In this particular story, a country is maintaining a fixed exchange rate and was forced into running balance of payments deficits. This was the U.S. in this case. When we asked what set off this particular process, it was an increase in the money supply domestically in the U.S. market. The U.S. increased the money supply, lowering U.S. interest rates, caused a balance of payments deficit to come about. And increases in money supply by central banks has particular problems or has had particular problems in the past which are very difficult to overcome and solve. In particular, increases in money supply tend to have two effects, a short-term effect and a long-term effect. The short-term effect of an increase in the money supply is the decrease in interest rates that we are analyzing here. The long-term effect of the increase in the money supply is inflation. Increases in domestic prices for all sorts of goods and services that are sold domestically. Inflation, once it starts happening, sometimes takes off at such a tremendous pace that it's almost possible to stop. And there have been numerous incidents of countries in the past 20, 30, 50, 100 years that have suffered the bouts of what we call hyperinflation. Incredibly rapid increases in prices that occur. And when that happens, the whole monetary system within a country, the pricing system, decisions about what's best to produce, what's best not to produce, everything gets messed up because the prices are rising so rapidly. So you may have seen instances of countries that end up with currency being devalued by so much that you need 1 million units of their currency to buy a loaf of bread. Right? One of my colleagues has got, I think, a $1 trillion Zimbabwean note? Something like that. So it's like a trillion units of Zimbabwe money from the recent past. And that's what you needed to purchase, normal everyday things. Now, how does it get into that situation? You usually get into that situation because of a couple of things. One is governments tend to run large budget deficits. They're trying to do everything for their people, but they don't want to tax them or can't effectively tax them too much. So revenues coming into the government are low. Promises made by the government are high. They end up with high deficits on their spending, and they don't want to deal with it by either raising taxes or cutting spending. So what do? They enlist their monetary authorities to print them lots of money. Because if you just print a lot of money, then you can keep spending it. And if you can keep spending it by the government, you can get elected next time if necessary. You can stay in power. Everybody will think things are going well. So you keep printing money to solve your problem over here, and this keeps going and going and going until you print so much money that inflation is what is the problem that arises eventually. Now, how do you solve that problem? One way to solve the problem is just instruct your monetary authorities to stop printing money. Okay, that's hard to do maybe, especially because really what you have to do is instruct your government to stop running such large budget deficits. Well, that's not so easy to do because that means you're going to have to raise taxes on people who are already hurting because of the hyperinflations you've caused, and you're going to have to cut the spending on the government, which is going to hurt government workers, and it's going to hurt social programs, and it's going to hurt everybody's going to get hurt if you try to balance the budget. So you've got very little recourse when you get yourself into that situation. So here's a solution. One solution is to tie your hands in a way. Make it unable for you to increase your money supply by too much. And one effective way to do that, fix your currency to another country. You just maintain and announce that you're going to have a fixed exchange rate to another country and you're going to maintain it. Now, that fixed exchange rate, as we've suggested here, is going to eliminate your monetary autonomy. You're going to tie yourself to the country through whom you're fixing. The reserve currency country becomes key. And if the reserve currency country is maintaining a prudent monetary policy and keeping inflation within their country low, then you will eventually be able to adopt that country's monetary scheme and also maintain low inflation within your country. That's a primary motivation for implementing fixed exchange rates. You're trying to eliminate the independence you have in your monetary policy, and you're trying to adopt somebody else's who's better. Now, that is exactly what China did back in the early 1990s. In the early 1990s, China fixed their currency to the US dollar. I'll draw it up this way. So they did something like this. Here's the quantity of RMB or yuan. Here's the exchange rate, dollars per yuan. Here's the demand for yuan. Here's the supply of yuan. And here's the fixed exchange rate, which let's say originally back in the early 1990s, it was set at an exchange rate of about 8.28. But it was 8.28 yuan per dollar, not dollars per yuan. So I'm going to write this as 1 divided by 8.28. That's the exchange rate to which they fixed in the early part of the 1990s. Now, one of the things that happened to China is that there was an enormous amount of pressure for them to sell assets or to sell in people wanting to buy into and participate in the Chinese economy. So there was a great, over time, increase in the demand for RMB. The demand for RMB went up for lots of different reasons. And the increase in demand for RMB is going to cause the RMB to appreciate in value, right? From the 8.28 to some higher value. But instead of allowing that to happen, China was trying to maintain their fixity of their exchange rate. So what they did is, China, when there is an increased demand for yuan, central bank ran balance of payments deficits, surpluses. And what that means is that they sell yuan and they buy up dollars. The buying of dollars means they increase reserves. Now, when China fixed their currency back in the early 1990s, they were suffering from a fairly hefty bout of inflation. Inflation was taking place, they were losing control of their monetary policy, they didn't quite know what to do, they decided to fix their currency at that time, and they fixed the US dollar as one of the strongest currency in the world market at the time, and it brought inflation down considerably in the Chinese economy during the 1990s and into the 2000s. Now, as China began to reinvigorate itself and actually grew fast and continued to grow fast into the 2000s, and as other countries stumbled, they actually implemented a policy where they were encouraging and wanted to increase their reserves. Now, there's a couple of important reasons for that, and I want to get at some of the issues here just briefly. One of the things that happened that affected China's policies in a big way happened in Southeast Asia in the late 1990s, 1997 in particular. What happened was called the Asian currency crisis. And the Asian currency crisis, it took place in 1997, and it started off in Thailand and in Malaysia, and then spread to Indonesia and South Korea and the Philippines and elsewhere. And what happened largely was that investors who had invested in those countries to a certain degree beforehand suddenly, kind of en masse, like a herd of activity, they all pulled their money out of those countries quickly. What would happen to a country's currency value if investors suddenly pull a bunch of money out? Plummets, right? Depreciates your currency suddenly. Quick change in your currency value, and if you're trying to fix your currency at that time, trying to prevent your currency from fixing is going to cause, from falling, is going to cause you to run a balance of payments deficit. So you're going to run out of the ability to do that, and you're going to eventually have to allow your currency to depreciate, which countries did. And the countries that did that, without going into all of the details of why, but what it caused was pretty severe recessions in all of the countries that were greatly affected by the currency crisis in the late 1990s. So all of the economies stopped growing, they declined for a short period of time, they suffered high unemployment. It was a rapid and a very dramatic, traumatic experience for these countries. But China was unaffected by the currency crisis in the late 1990s. And that was largely because there was not an enormous amount of foreign investment into the Chinese economy. So there wasn't a lot to pull out from China. In addition, it's worth noting that China has a fairly large-scale level of currency controls or exchange restrictions in place. You can't invest freely in China. You can't just say, hey, I've got $1 billion, I'm going to invest in China, buy into their stock market. No, a lot of their stocks are closed off to foreigners, and you can't purchase stocks freely, portfolio investment in that particular way. You can invest in companies, but you have to have shared ownership a lot of times, and at least in the past you've had to do that. And so you would have to find a foreign partner, and you could only invest up to a certain amount. So there's restrictions on how much investment can go in, but most of the investment that went into China in the late 1990s was of a sort where you're going to open up a factory, you're going to run it, you're going to be directly responsible for it, as opposed to, I'm going to stick my money in the stock market, which maybe tomorrow I'll decide to pull out and pull back home. So portfolio investment tends to be it moves back and forth quickly, potentially. Long-term investments, foreign direct investments, is the kind of investment that can be lasting. So anyway, China had a lot of foreign direct investment in the late 1990s and early 2000s. And so when the currency crisis hit, investors didn't pull out quickly. China didn't suffer a recession. They continued to grow, just like they always had. They were unaffected by the currency crisis. But China, witnessing all of the demise, if you will, to the economies around them, was very, very worried about what might happen in the future if they were to befall or face a similar circumstance or situation. All right, yeah.
Why did the investors pull their money out of Southeast Asia, not China?
It's a good well, not in China because it was more long-term investment, so they didn't run away. It was just harder, and they were making longer-term commitments. So you don't just pull out on a dime because...
So basically they aren't able to. There's more roots in their investment.
Exactly. Yeah, that's a good way to put it. More roots in their investment in China.
But
why they pulled out elsewhere? Well, that's a story that you can argue about. And, there's a lot of stories about how there was a sudden concern about the healthiness of the banking systems and financial sectors in these countries, and so investors pulled out. But it really was kind of like a herd behavior. It's like a few investors, and some people have argued that George Soros pulled out early in Thailand and Malaysia, and then everybody kind of saw it and said, oh my gosh, what is he doing? Why is he pulling all of his money out suddenly? Maybe I should pull my money out too. And then everybody started doing the same thing. So even though there might not have been any underlying reason to pull all of the money out of those countries so quickly, if everybody acts on that, it's going to have the negative effects that would be predicted. Yes, self-fulfilling prophecies will take place. And so that's likely to be what happened in Southeast Asia. So you end up with a really bad economic situation, all because investors kind of have the ability to move their funds in and out really fast. That has led some countries, like Malaysia as an example shortly thereafter, to put into place currency restrictions or restrictions on investment that basically say you can invest in our country, but if you want to pull it out, you can't pull it out fast. You're going to be restricted on how quickly you can bring it back, and that's going to prevent these things from reoccurring in the future. All right, now, I want to get to the China story real quick, though, and just kind of finish up some bits and pieces of this. So China is concerned about Southeast Asian currency crisis, and one way in which they can prevent this from happening in the future is to do this: build up reserves. So if they can build up a sufficient amount of foreign reserves, then if in the future investors in China suddenly want to pull out, they can maintain the safety and stability of their economy, maintain the fixed exchange rate, not have to suffer a dramatic depreciation by selling off their foreign reserves as needed. But then you could ask, well, how much do they need in order to prevent this from occurring in the future? And there the answer is, well, nobody really knows. But they started to accumulate and accumulate and accumulate until they got to $1 trillion of foreign assets in the 2000s, and then they got to $2 trillion. Then the financial crisis hit, and they increased even more to $3 trillion and $4 trillion, which was an amount of reserves that other countries had never held before. They just don't have that amount of foreign reserves. All right, now, during that same period, you would say, oh, well, by buying up all these reserves, and therefore selling their own currency, they were basically they were causing their currency to depreciate in value. So you can push your currency down in value. That could give your exporting firms an advantage because their prices are going to be lower to foreigners. You could sell more goods, run a big balance of payment surplus. Everything could look good if you run your currency lower and lower and lower. But China actually didn't do that. And instead, what they did is they had lots of pressure for their currency to rise up in value. And they allowed their currency to rise up in value starting in 2005. So it rose from 1 over 8.28 to 1 over 7 to 1 over, at the low point, about 1 over 6.1. So notice that the currency goes from 8 yuan per dollar to 7 to 6. The Chinese currency is rising up in value relative to the dollar. Now, they were allowing their currency to rise up in value while at the same time they kept accumulating foreign reserves to a degree. Had they let their currency float, their currency would undoubtedly have risen up even more in value. So, the critics in the United States and Europe who claim that China is a currency manipulator are basically arguing that China should have allowed its currency to rise up much, much more, and that by virtue of intervening in the market for so many years, they have kept their currency at a lower value than it would have been otherwise. And that undoubtedly is true. It's lower than it would have been had they maintained a fixed exchange rate. So on that notion, you could say they have indeed manipulated their currency. On the other hand, they're doing it with a different purpose in mind, I think, and it's largely the financials here. They're trying to maintain a high enough stock of foreign reserves. They're trying to maintain kind of order in their economy to make sure they don't have a sudden shock that's going to cause things to go under. Now, really quick, here's what's going on in China recently. In China recently, the exchange rate has gone from 6.1 about a year and a half ago or so, downward to about 6.7 RMB per dollar today. So it started to come back downward. The reason is that there's an increased desire now to get out of China. Exactly the thing that China has been fearing for a long time. There's an enormous amount of pressure to pull assets out of China and to invest elsewhere in the world. If left alone, that would mean that their currency would depreciate in a floating exchange rate dramatically right now. Not appreciate, it would depreciate under certain current circumstances. But what China has been doing in the last year is intervening by running balance of payments deficits. They've been selling off their foreign reserves in order to prevent an even greater free fall of their currency that the private markets would be calling for right now if they allowed it to happen. And China's currency has fallen from 6.1 to about 6.7, and they've sold off about 1/4 of their foreign reserves in the past year or so. So they're down from about $4 trillion to about $3 trillion, and they keep selling more and more off every month. Again, if they didn't have those foreign reserves to sell off and they let their currency float, their exchange rate might well be plummeting at a much faster rate today. Falling, note, falling. Critics in the US and elsewhere keep saying we want them to raise their currency up. But the market conditions on the financial side today is causing their currency to fall, and they're preventing the fall to be even greater by intervening on the foreign exchange market. So anyway, the story about China is really, I think, a story about, yes, intervention in their foreign exchange market. Reason why? Mostly initially in order to ward off inflationary effects. Secondarily, though, they've built up their foreign reserves to the extent that they have, probably more than they ever intended, largely to try to ward off the problems associated with a sudden flight of capital, movement of capital out of their country, which is something they're actually starting to see right now in a fairly big way. Purpose for doing that? Maintain stability of their markets. If they can keep their exchange rate semi-fixed, steady, move it at only incremental levels rather than allowing it to rise up and fall with the whims of the market, they are hopeful that they're going to be able to maintain a steadier course for their economy and maybe ward off a deep recession like was suffered by the countries in other Southeast Asian areas in the late 1990s. Whether that will be successful or not, we'll have to wait and see. But that's largely the motivation, I think, and that often gets ignored or gets overlooked because there's so much attention, I think too much attention, that's put on The trade deficit means, what does it mean in terms of exports of goods and services? And what does it mean in terms of jobs? And nobody's ever really telling the public about what's going on the financial side and the other side, which is a much more important component, I think, of trade deficits and surpluses. All right, let me summarize. Let me take a question.
So when they wanted to keep the currency lower, they were doing that so that it would be cheaper to buy Chinese goods?
That's the typical argument, right. And there is a situation, currency manipulation, if you want to use that term adequately or appropriately in a context, usually occurs when a country is basically in a recessionary period or trying to avoid the effects of a recession. So output is going down, jobs are being lost, unemployment is going up. One way you could try to stoke your economy, get it going better, is to depreciate your currency. So if you depreciate your currency, it's like putting your goods up for sale in world markets, making your goods become cheaper, foreign goods become more expensive to you. So your consumers are going to stop buying foreign goods, they're going to buy your goods instead, and foreigners are going to buy more of your goods. That's called a competitive devaluation. Devaluing or depreciating your currency in a rapid and methodical way in order to stimulate your economy, and it will come at the expense of other economies in the world by doing that. And manipulating your currency in that way was something that was a very common phenomenon back in the 1930s, for example, during the Great Depression years. Okay, but it was when a country had a fixed exchange rate and then they lowered the fixed exchange rate dramatically in order to benefit their economy. And that's something which China hasn't really done. They've had a fixed exchange rate, but they haven't ever really lowered it in nominal terms. In fact, they've allowed it to rise up during the period of time that they've been called into question for manipulating their currency.
But just not as much as...
Not as much as it might be necessary in order to balance trade, which for some reason some people think is the goal that we're supposed to be striving for. As we've talked about in this class, it may not be worth thinking about as that being an appropriate goal. There's nothing magical about being in balance on trade, or that being somehow fairer than imbalance. It just has to do with how much borrowing and lending you're doing internationally. Yeah?
Is there like a discussed explanation for why people want to pull out of China recently?
Chinese economy is not very healthy lately. They have been overspending and overinvesting. They have an enormous overcapacity problem. And they have been producing and producing, keeping their numbers high, but there has not been enough sufficient demand on the other side in order to sell all of those products off. So they could either keep growing by continuing to produce more and more goods that nobody is demanding, or they have to stop at some point. And there's an increased concern that they have increased their debt to such a degree, they have overspent and overinvested to such a degree that it just is something that can't continue any further. So there's an awful lot of people in China who are thinking the future doesn't look very bright, we better get out now rather than later. And so that's, I think, fueling a lot of desire to get out of China at this particular stage. The numbers, growth has been falling from the 10, 11% range down to the 6% range or so now. Many people look at China and think those numbers might be inflated, it might be much lower than that. So there's a lot of real concerns about the health of the Chinese economy right now. And I think that's one of the main reasons why people are trying to get out. Now, they can't get out of China easily because there are a lot of restrictions on moving money in and out of China. So that's also another way in which the government controls its economy and tries to prevent the really negative outcomes from occurring, which is everybody pulling out altogether at the same time. So it's not so easy to do it there either. And that is, I think, helping keep up and prop up the Chinese economy for now, but it's a question as to how long that will actually last. Now, back to fixed and floating exchange rates. In terms of fixed versus floating exchange rates, just the basic idea of them. Fixed rates have their place, and a lot of countries have chosen to adopt them to help reduce volatility, to help increase certainty in markets to the degree that they can. And there is some value, I think, in promoting and even using and maintaining fixed exchange rates for some countries. It's worth noting that prior to 1973, the entire world was under fixed exchange rates, and it was thought that that was the only way to go. Floating exchange rates would never work, people thought. It would never be possible to maintain any kind of security or certainty in markets if there were floating exchange rates. But they have come about. The developed countries are using them, and they have come up with a variety of ways to make it possible to hedge against the negative effects that can come about because of exchange rate changes. So floating exchange rates can work too, but they have problems associated with volatility and maybe extra costs associated with maintaining and keeping them viable. You know, floating exchange rates change pretty dramatically from time to time, and it can upset markets. The dollar, for example, has been rising in value pretty consistently for the last year or two, and it's affecting our ability to sell goods in international markets, and it's affecting potential growth rates of the economy. There's a lot of people who are worried about how much it has risen up. That's a constant concern. People are always questioning whether the exchange rate that prevails is the appropriate one or not. With fixed exchange rates, an important component of them, though, is that you give up your ability to control your own money supply. You give up your control of your own interest rates. You lose monetary autonomy. Now, to some countries, like China back in 1994, they wanted to lose their monetary autonomy to try to get inflation under control. And that is a very reasonable reason to implement fixed exchange rates. And it's probably the primary reason most countries have moved to them at one point or another. But there's other reasons too. I mean, the European Union banded together in a system of fixed exchange rates within themselves, and the idea was that it was going to connect them more effectively to each other, right? It was going to eliminate the transactions costs that are necessary to convert from Deutschmarks to French francs, and it would integrate the market and make it more vibrant. So having fixed exchange rates within Europe was thought was going to expand and lead to all things bright for the future, until they ran into the difficulties that they're in today. But some countries, like Britain, back in the day when the euro was about to be implemented, they stepped away from the euro. They were never a part of the euro, right? Why? Because Britain wanted their monetary autonomy. They wanted to have their own independence, be able to control their own fate, their own money supply, and they didn't want to be beholden to the European Central Bank because they could not effectively control or affect the decisions 100% that would be made there. So Britain opted for monetary autonomy, and now they're opting for complete autonomy out of the European Union as they Brexit in the near future. One of the benefits of having floating exchange rates can be that you get that autonomy back. You can control your own destiny. You control your own fate of your economy. You're not beholden to anybody in particular, and that's one of the strengths of floating exchange rates. So I'm going back and forth in terms of the pros and cons, and that should be illustrative of the fact that there's no one answer, one right answer to whether countries should maintain fixed or floating exchange rates. They each have their place. They each have positive aspects to them. They each have negative aspects to them. And there's nothing right or wrong about 100% about either of them.
I just want to make sure I'm clear. The only way you can fix is through your balance of payments, like when you're
Running balance of payments, deficits, or surpluses.
Value starts rising, you start selling the currencies that.
Now, I wouldn't say that's the only way. The other way is through mandate and control. So you could just say, look, we're just making it a law. You have to fix it. You have to exchange at this exchange rate, and if you don't, we're going to put you in prison or something. So you could do it that way. Yeah. But that opens up the potential that you lose control because of black market activity and the like. So it has lots of other associated problems with it. So the kind of the regulated market way of intervening and keeping fixed is by running these balance of payment surpluses and deficits. All right, one last comment, and then I'll let you go. The US dollar is referred to as the world's reserve currency. I just want to comment a little bit in the context of what we just talked about, what that might or might not mean. First of all, The US dollar was indeed the reserve currency in the fixed exchange rate system that prevailed after World War II, the so-called Bretton Woods system. So the way that system was set up is that all of the countries that were participating, Germany and Britain and Japan and others, they all fixed their currencies to the US dollar. All right, so the dollar was the reserve. They held reserves in their central banks, and they bought and sold currencies on a daily basis in order to maintain the fixity of their currencies to the US dollar. So the US was a true reserve currency at that time. Once the Bretton Woods system fell apart in 1973, we were no longer a reserve currency in that context, because countries were not fixing to the US dollar anymore within that system. In the interim, though, there are a number of countries around the world who have chosen to fix to the US dollar as their reserve. And from the perspective of those countries, the US is indeed the reserve currency. But reserve currency has come to mean a little bit different in today's world, because we're not in a 100% fixed exchange rate system. Reserve currency has come to mean the currency of choice for transactions. Whether countries will hold on to it or use a currency, hold on to it as a store of value, use it to make transactions, even if they're not an immediate part of the country or the economy in question. And the dollar has been playing that role to a large degree, even after the breakup of the fixed exchange rate systems back in 1973. So in that respect, the US dollar holds a central and important role in the world's economy. And that's largely because even when things go bad, or especially when things go bad, where people move their money to in order to find a safe haven tends to be the US, and tends to be Treasury bills more specifically. So as long as the US economy stays stronger and more reliable than the rest of the world, the US will continue, I think, to enjoy this reserve currency position. And questions about whether China's RMB could become a reserve currency is probably quite a few years in the distance, because China's currency is just not as reliable. It's not tradable easily in and out. You've got restrictions on what you can buy and sell with yuan, and you've got the uncertainties inherent in the Chinese economy today. You've got problems with the legal system and whether you can count on investments to the future, because they don't have a rule of law per se, and all of these things make it more difficult for the Chinese RMB to rise to the role of a reserve currency as the United States dollar has been recently. So those are just a couple of thoughts, a lot of thoughts on fixed and floating exchange rates. And I'm going to stop there, but I think that's plenty of stuff.